Hey everyone, it's Daniel here from InfoRest. Hope you're doing well. Let's talk about an interesting survey that came out from Bank of Canada. It came out today. However, it's a survey that was conducted from September 20th to 28th of this year. Although it is a little bit old and stale, but it's still relevant and important because it has a lot of good information that you can get an idea of how certain banks and financial market players are thinking about the economic outlook. So, this survey comes out again from Bank of Canada. I'll leave the link in the description for you to read up on this survey. And basically, it's titled Market Participants Survey, third quarter of 2023. So basically, this survey is a questionnaire that's sent out to 30 top financial market participants, including banks and all of that. And they go out, Bank of Canada goes out, asks them certain questions about their economic outlook. What do they see in terms of GDP growth, inflation, interest rates, housing market, etc., etc. So all of that is in that link that I'll post in the description for you to read up on. But I'm going to summarize a few things for you that need some attention that I think are quite interesting. So first things first is that in the survey talks about the probability of a recession. So the median forecast, the majority of the participants feel that there's a 48% chance that we could see a recession in the next 6 to 12 months. So we're talking about that it's very likely we could see a recession kick in literally next year. And that's what these participants feel, 48% chance. Yes, it's not higher than 50%, but 48 is still high up there, right? The other thing that was mentioned in this survey is the CPI, which is inflation, which is an inflation metric that is heavily watched by a lot of the market participants out there, by traders, by investors, economists, financial managers, and maybe people like you and I, right? So Consumer Price Index, CPI, they basically see, the participants see that you could see CPI hit, the headline number hit 2.2% by the end of next year, by the end of 2024. So that's their forecast. Now, 2.2% is higher than the 2% target. Remember, the Bank of Canada wants to hit the 2% target. And how do you get there? Is you want the number to drastically fall, not just to 2.2 or not to just even 2%. You want to fall below it a couple of times, take an average of that, the mean of that. If the number's below 2%, then yes, you can get that average because you'll get spikes, right? Spikes, let's say the CPI number will come down to 1.8, then 2.2, 2.3, 1.7, blah, blah, blah. You get the point, right? But the idea is that the participants see that the number will hit 2.2%, which is close enough to the 2% target. Now, what's very interesting in the survey is the interest rate component. What's very interesting is that the market participant sees that Bank of Canada could cut rate starting in April of next year. So first rate hike is seen in April, then the second one in July, and the third one in September. So very interesting that next year you could see rate cuts start to come in. And by the end of 2024, the market participants expect that rates to be around 4%. Right now it's around 5%. So basically about 100 basis point rate cuts are expected next year. Now why? That's very interesting, right? You might hear that, people come out, if they start to hear that rate cuts are happening, that say, hey, that's a good thing. That's a good thing. Rate cuts are starting to show up, right? We got also 100 basis point rate cuts. So now that's going to ease certain situations. And if I were to estimate of why that would happen, about 100 basis points, it's not a small number, but also not so big as well. It's relevant, but 100 basis points is still important. And why it's being done is because remember, what did RBC say, Royal Bank of Canada say? that by the end of next year and in 2025 and onwards, those renewals are going to come in and they're going to hit a lot of Canadians out there. So is this 100 basis point rate cut that the banks see is basically, a way for Bank of Canada to come out and say that, hey, we're going to try to soften things so that when those renewals come in, people are not hurting that much? Well, it's only a 100 basis point rate cut, right? We're just bringing rates from 5 to 4%. And then if you look at your mortgages, right, if you're getting a mortgage, let's say right now, if it's around 6% or 7%, your stress test on that mortgage of getting any approval is around, let's say if it's 6%, might be around, stress test might be around 8%. If your mortgage is 7%, your stress test might be sitting at 9%, right? A mortgage agent will know more on this better than me, but that's the idea, right? Now, if you get it down to, let's say 4%, 100 basis point, right, it's still high up, right? The mortgage rate that you're going to have on when it comes to renewal is still it's still not anything amazing, because if you were used to, let's say 2-3% in your mortgage and that jumps up to now, let's say 5-6%, even 5%, that is still a big significant move in your payments. You're going to pay much more, so definitely that's still going to create some pain. Now, another thing to note also is that when these rate cuts start to happen, okay, a lot of people will say, okay, that's the time to go out and lever up and buy because, great times are coming. Sure, if you are getting a Goldilocks soft landing scenario. Now, the thing is that, okay, what's the probabilities of that happening, right? Rate cuts to happen by 100 basis points next year, and then onwards, continuation of, more rate cuts to come in, because also in the survey, they see another 100 basis point rate cut in 2025. So about, actually a little bit more than that. So the rates are seen around 2.88%. So we're at 5%. Next year, by the end of next year, 4%. And then by the end of 2025, another 100 basis points, or a little bit more than that, 2.88%. So you're going down by 100 basis points or a little bit more, right? Lower and lower in rates, because you are anticipating some pain. You're anticipating inflation is going to come down. Now, when you look at historically how things play out in terms of inflation and rate hikes and rate cuts, is when central banks go out starting to cut rates, you tend to see the actual recession show up. The hard landing scenario, which tends to be a higher probability in past studies, past historical recession studies. If you look at it, right, just take, for example, 2019 as an example. What happened in 2019, right? 6 months prior to COVID pandemic. Even though no one could predict it, but there was a 75 basis point rate cut. What happened in 2007, right? September 2007, all throughout 2007, that year, 100 basis point rate cut. And then what happened in 2008? More rate cuts, another 100 basis, actually more than 100 basis point, but there was basically 100 basis point rate cut leading to September 2008, and then you got the crash, right? Going back to the 2019 scenario again, 75 basis point rate cut. What happened in 2020? COVID hit, and you got a massive rate cut again because of COVID in March. Same thing in past recessions, right? When you get something happening in the economy, it starts off with these rate cuts, even though you don't see it, even though it doesn't feel like anything. And you're going to hear the narrative. Everyone's going to come out. All right? Everyone's going to come out. Your realtor, your best friend, your so-and-so, whoever it is, right, are going to come out and say, look, rate cuts are coming down. Assets to the moon, real estate to the moon, stocks to the moon. sure, I agree. Eventually easing is going and pumping money in the system and cutting rates is good for assets, but not just yet, not so quickly, unless you are predicting that this is going to be a soft landing, and there's no hard landing, there's no hard recession, unless you have some sort of you know your analysis tells you that this is going to be definitely a soft landing, not a hard landing, then sure, everything to the moon, maybe even, and I'll still put a maybe on there, an asterisk, because if it's soft landing, why should you ease any further? The economy has handled its situation by itself, right? The inflation is also handling handling the situation by itself. So why need to cut any more? Why need to pump any money further? I mean, if you do that, and if it's a soft landing, you're just going to reignite inflation again, which is going to make your job even tougher as a central banker, and you're going to have to hike rates again. So again, going back to my point, I just don't see how cutting rates is positive short term, short medium term. I totally understand long term, but I'm saying that when this happens, it tends to signal, especially when you look at history, 2019, 2007, right? Previous recessions also, when you start to see these rate cuts, it means that there's trouble ahead. It means there might be a credit event, might be some pain. And don't think 5% down to 4% is fantastic. It's still high up there. It's still high up there to 2008, 2007, 2008 levels, right? So, and plus all the tightening that we've seen, and the data that is starting to show weakness, there's a lag effect. We will see more of that play out next year. So if the market participants see that rate cuts are going to start in April, they must probably see some sort of recession coming in, and especially that hard landing that's going to even bring in more rate cuts faster and harder depending on the type of recession and hard landing. And that's why in that survey, you see that probability of 48% chance of a recession in 6 to 12 months. Now, of course, these projections, these probabilities, they change. We'll wait for the next report, the next quarterly report. We'll wait to hear more on the survey and how things play out in terms of data and so on. You'll hear it all on this channel. So let's wait to figure out more on the data and how things come out and where things are heading in terms of data, in terms of market reports, surveys, Bank of Canada, the Federal Reserve, central banks out there, the speeches, the comments, fiscal side of things, monetary side of things, governments, and yes, geopolitical tensions that are happening globally as well. So I'll talk all about it here on this channel. If you're new, subscribe, hit the like button, the bell icon to be notified on the next video. Let me know what you guys think. Leave a comment below, and I'll see you guys around. Cheers. Bye.